This video presentation is brought to you by managementstudyguide.com. Hi folks, welcome to the video tutorials for financial accounting, the numbers game. In this video, we will begin the module on balance sheets. So, obviously we must begin with what a balance sheet is and what are its contents. That is precisely what we will discuss in this video. So let's begin by understanding what is a balance sheet at all. Let's take the analogy of a mark sheet or a report card that we receive in our school days, and then let's compare it with balance sheets and income statements. Notice the fact that a report card pertains to one particular period only. You get a mark sheet for semester 1 and then for year 1 and so on. That is, this can be compared with an income statement. The income statement tells you exactly what happened in a particular period of time. Will the income statement for that period give you any information regarding previous periods? No, not at all. This is the similarity between report cards and income statements. But then there is also a difference. Firstly, let's say you obtained 95 on 100 in this year's test. Well, congratulations to you, but the truth is that it ceases to matter as soon as the year is over, right? When you go to the next year, everybody's score resets to 0 and you start new, correct? But of course, this is not what happens when money is concerned. If you made $10,000 in income this year, you're going to make a record of it somewhere, right? Guess what? This is kind of one of the main purposes of the balance sheet. So let's say you made $10,000 in income this year. You will transfer this 10,000 additional dollars to the balance sheet where it stays permanently, and then the income statement resets to 0 when a new period begins. So we can kind of think of the balance sheet as a cumulative mark sheet or a report card. It adds up all the marks, that is, profits and losses, over all periods and tells us the current financial position of the company. Notice the difference. Income statement only tells you what happened in a given period. Balance sheet tells you the cumulative effect of each and every transaction that the company has ever undertaken ever since it came into existence. Hence, the balance sheet presents a cumulative picture of what we gained or lost as a result of what we have done since the beginning of the firm's operations. Now, since we have a basic idea of what a balance sheet actually is, let's look at its contents in a little bit more detail. On a very basic level, the balance sheet has two sides. On one side, we have assets, and on the other side, we have liabilities. We have used these words earlier, and we have also defined them in an earlier video. Let's just review the definitions now. An asset is anything for which outflow of cash has already occurred, but the value has not been consumed. The same thing can be an expense or an asset depending on when value gets consumed. Consider this example. Insurance for the current month will be an expense. Prepaid insurance will be an asset because we have paid for the insurance now, but we have not consumed it until now. Same is the case with prepaid salaries or prepaid taxes or prepaid rent. Simply put, anything whose value outlives the balance sheet date or the date on which the balance sheet was prepared is called an asset. On the asset side, we have various classifications. For instance, we have current assets, we have fixed assets or the non-current assets, then we have investments, then we have intangible assets. For the moment, we do not have to worry about the classification. We will deal with them in a later video. Now, moving on to the liability side. A liability is the exact opposite of an asset. A liability is when inflow has already occurred. That is, we have already consumed the value, but we haven't yet paid for it. So consider the case of unpaid salaries. Well, the workers have already worked and we have gained the benefit from their work, but we haven't paid out the salaries as yet. Similar is the case with unpaid rent, unpaid insurance, etc. And this is why all these will reflect under the liabilities section. Similarly, when we take a loan from someone, we have already received the benefit. However, we are yet to pay back both the interest as well as the principal. Hence, these amounts will also reflect in liabilities. Like assets, once again we have current liabilities and long-term liabilities or non-current liabilities. But there is an interesting thing on the liability side of the balance sheet. This interesting and counterintuitive part is that we are considering the situation from the point of view of the entity, that is, the entire firm, and not from the point of view of shareholders. So, now what we just listed down are liabilities which the firm owes to outsiders or third parties. But since the firm and shareholders are technically two different parties, the firm also owes its capital and any profits that it has made over the period back to its own shareholders, right? Well, it's like owing money to your own self, but technically shareholders and the entity are different. That is why the company owes money to its shareholders, and this is what we list in the owner's equity section. So, liability side actually has two subparts. One subpart tells us what the firm owes to outsiders or third parties. The other tells us what the firm owes back to its very own owners. The objective of the whole business is to maximize the asset side of the balance sheet. While doing so, they have to minimize the liabilities, that is the money owed to outsiders. When both these things are done simultaneously, the firm ends up maximizing the owner's equity. In simple words, that is when the firm makes its shareholders rich. So now, before we end, let's quickly summarize what we have learned in this video. Firstly, the balance sheet records the cumulative effect of each and every transaction that the company has ever undertaken. So if a company is 200 years old, the balance sheet will reflect a cumulative effect of all the transactions that have happened in those 200 years. Secondly, the balance sheet has two sides. One is the asset side and the other is the liability sides. These two sides must always balance, which is why this document is called a balance sheet in the first place. Thirdly, the liability side is further subdivided into two parts, which are liabilities or the money owed to outside parties, and equity or the money owed to shareholders who are owners of the company. Then each of these three components, that is assets, liabilities and equities, can be further subdivided into smaller categories or account groups, the details of which we shall learn in the next videos. So, for the moment, this is it. I hope you found this video interesting as well as informative. I hope you subscribe to the channel and hope to see you soon in the forthcoming videos.